8 countries across 3 regions, the UK, Nordics, and Greece. And when we look into it a bit more, we know that they have 35,000 employees, over 830 stores, which is quite a large number when you think about it. I mean, 35,000 is a big number. So we can go a bit more into that later on and how they've managed that after that. But yeah, it's a pretty big number. But the company, in essence, makes its money directly through selling products through its omni-channel platform. So whether that's through the store or through its online website.
Okay, what is the revenue split between online and like brick and mortar sales? Does it change as well between different countries?
Yeah, so I think probably the best way to do it is maybe look into our notes so people can see the chart. For those who are listening on the podcasts, they can click on the link below or in the description to access the note. So if we look into the note specifically, we can see that when we look at the revenue split overall, we have half of it from the UK and half of it in the sort of the Nordics regions, which is, Finland, Sweden, Norway, Denmark, and then you've got Greece. So it's a fairly even split. And then when we look at further the split via the countries of where that sales comes from versus in-store and online, you can see it's still predominantly 33. When you look at an aggregate basis, 33% of it's coming online. And that's really driven by the fact that in the UK, it's in-store is more than online, but online is very large. And then it's the other 2 areas where the other 50% of revenue is coming from, which has very little online sales. Greece has hardly anything, and then sort of Nordics as well. So yeah, it's all being driven by the other regions which don't have much online sales. So the split is at the moment, it's a 70-30 split online versus in-store. So in-store still being the major revenue generator for the group.
It's interesting to see how management has obviously been focusing on expanding its online sales here in the UK, but abroad seems to be a bit less of a priority. But
it might just be logistics and know-how and things like that. Yeah.
Actually, that's a good point. It could just be that they haven't got an established sort of logistics network abroad, whereas in the UK, that's obviously not the case, looking at those numbers. So as a retailer, it's going to be the standard sort of structure where they're buying products and then reselling them. I looked in your notes and basically Currys doesn't create any of its own branded products. It's like reselling other brands. In terms of expenses then, where's the money going and what's the state of margins?
So when you don't sell any of your own products, your margins often are very thin because you're just earning the retailer margin on third-party products. And it's expenses. It doesn't really break it down in the annual reports of recent where that sort of expenses are. So what we tend to look at, what I looked at in the notes, is looking at margins. So margins gives us some idea of, okay, what does the cost structure looking like in the business? And I looked at margins in the different areas. And in the UK, you get a new EBIT, which is an operating margin of sort of 1.3%. Then Nordics is closer to 2.6 and Greece 3.9. And that gives us an idea that actually it's low single-digit margins. So if things were to go sort of down south, or things they didn't sell enough of their products, whether it was a recession or just through other people buying, some of the customers buying it from other platforms versus some of their competitors, then it's probably going to go through quite a difficult time because it just doesn't have enough. It just doesn't generate enough sort of operating profit from a not a margin for it, sorry. What I'm saying is it's very thin margins, so it's not great. It's not a great, exciting business. Can't do much right. It doesn't have much optionality. So it is something to be concerned about. Management have been talking about having long-term margins around 4%. That's their aim, but again, that's not very exciting either. So it's a very thin margin business. And from my perspective, and I'm sure as well as you, the other analysts on the Money Cog, is businesses which have very thin margins, they don't have great optionality in terms of not generating huge amounts of free cash flow. They don't have huge amounts of things they can reinvest in. And that's probably why they don't have many of their own branded products, because probably don't have enough capital to invest into a warehouse to build them, and probably just don't see the need to do that because they can't compete with third-party products because they just don't have the scale. I mean, if you look at Amazon does do that. Amazon can produce it, but it probably does that at a loss-making at the beginning to get market share. And then,
well, with Amazon, they've obviously got the advantage of all the enormous cash flow generated by Amazon Web Services.
Exactly, yeah,
rather
AWS.
from there. Yeah. So we've seen companies, even with thin margins, obviously, we've seen them succeed. I think Tesco is a perfect example of this, and this is mainly driven by just increasing the sales volume. So rather than focusing on high margin products, you sell a lot more of low margin products, and then as a consequence, your cash flow expands. That's the general business model of most retailers. So the question then becomes, have revenues been growing? If margins are staying thin, has the top line been able to increase to compensate?
Well, no, actually. So since 2017, if you look over the last 5 years, it's been fairly flat, sort of around the 10.5 sort of billion mark. It's never really reached beyond that. And that's probably due to the fact that, as you just mentioned, that when you look at retailers, whether it's food retailers or any retailers, it's a volume play. You've got to sell volume versus you don't have controls over price. So it's all about sort of volume and being able to sell volume to generate massive revenues. And they just haven't been able to increase revenue. And I think a lot of that's due to the fact that, on the one hand, we talked about 830 stores. So there's only so many stores they have. And then the other part is just being able to get enough people to buy their products. And to be fair, we have gone through a pandemic. So the last 2-3 years has been hit by a pandemic, which favors online versus in-store. You couldn't go to Currys and buy things. Most of the stores were closed during the pandemic. So a lot of it's favoring online versus in-store, which Currys has not really, as we talked about earlier, it's not probably the number one place that people go to when they're buying technology products online, given sort of speed and things like that. But they are pretty good for services and quality. So yeah, that's hasn't really done much, to be fair, in the last 5 years. And something that you sort of think about, okay, going forward, what does that look like? And we'll talk about that a bit later. But yeah, it's not looking that great so far.
No.
but then a company's past performance is an indicator of future performance.
That's also true. We've seen companies that were stagnant for years and made a sudden comeback for a variety of reasons. Just to add a little bit more of the negativity before we start looking at the more positive traits. In the research report, you pointed out the group has accumulated quite a large pile of debt. I wouldn't be surprised if the pandemic obviously contributed to that. Is there a cause for concern? Is this debt manageable?
There's 250 million of cash. Its debt has decreased from 2020. It's sort of halved. So it's something to worry about and something to think about. But at the same time, the company has aiming to generate free cash flow of 1 billion over the next 3 years, and with a margin uplift, it should be something they could sort of repay. But regardless, if we go into a recession or competitive landscape, then yeah, that debt is something of concern, and the repayment of that is something that we have to think about. Most likely, they would refinance it at a much more expensive,
especially with interest rates currently rising.
Exactly. I haven't done it in the notes exactly when that debt is going to be due, but that's what they could sort of do in the short term, always refinance it, and they should be able to do that. But I mean, they have also announced on the back of that 75 million share buybacks, as well as increases in dividends. They're doing things right for shareholders, and probably for UK retail. A lot of UK retailers, not UK retailers, UK investors tend to love dividends. I don't know if you noticed that. Yeah, they love dividend-paying stocks, and it's one of the big things. So Currys sort of fits nicely in that when they sort of talk about dividends a lot.
I suppose if they're still returning capital to shareholders through buybacks and dividends, then clearly management is confident in its future outlook. So even if there's not much growth, then their ability to continue churning out profits it indicates the debt, in their opinion, is manageable, even with the additional capital being returned to shareholders. And from investors' perspective, if you're looking for sort of like a steady passive income source, then maybe Currys is for you. That's the impression I'm getting from what management have been doing, according to your notes anyway. But obviously that comes with a caveat. If the share price falls, then that passive income is obviously not really meaningful. So what has the stock done in the last 5 years?
It's gone one way, which is south.
Okay.
It's gone from sort of 300 to sort of 79. So it's gone one way, and that's understandable because we've seen revenue hasn't really done much, and business hasn't really done much in a very competitive landscape. So the view is, well, can it really survive online? Can it really survive the online sort of digitization of e-commerce and be able to capture market share on that? So that's something that obviously people have concerned people. Within year to date, it's fallen 32%. So much like some of the tech stocks. So it's had the same hits, probably because of recession fears.
Yeah.
And we're with being a retailer, and like we said, it's not a consumer staple, it's a consumer discretionary sort of stock. So again, these are all worries for the market. And like I said, it's not got great. We can talk about the competitive advantages and disadvantages later, but some of its disadvantages are more exposed in this market environment.
Yeah, especially with, like you said, there's obviously the fears of recession when you've got also the energy bills going up, inflation on top of that. I don't think many people are looking to buy new pieces of technological hardware like TVs or sound systems. So that's not great. It makes sense why the stock has fallen basically by a third since the start of the year, though. Okay, let's start looking at some hopeful positives after all this. Management. Who's in charge, and what do you think of the CEO?
Management is an individual called Alex Bladcock. He was the CEO of a group called the Very Group, which was essentially a multi-retailer, online retailer, a multi-brand online retailer. That was, had a heavy online presence, and he's been a CEO since 2018. Hard to say, because between that period, within sort of 18 months of that, he had a pandemic to deal with. But looking at the UK, he's clearly done a good job of having the omni-channel strategy. I think that's a key focus for him, is moving things to a online versus an offline play. And I think one of the key things which Currys is good at is their services. They provide good services and allowing you to have a selection of products that you could pick. If you don't know what the best product is, it's always good to go into a physical store and see what your options are and then compare them, right? Whereas we can't do that sometimes online so easily. So it's got that aspect there. He has, in terms of his salary and how he's compensated, he's paid very handsomely, 880,000, which is quite expensive. But we've been talking about CEO salaries for a while, and they all seem to be north of quite a hefty amount. But I guess it's just the nature of maybe the demands of the job, and being a publicly listed company is probably quite stressful. So they probably feel they need to be compensated for that stress. His bonus structure is 150% of base, of which a third is actually a third of that is given to long-term incentive board of shares, which are linked to obviously long-term incentives, but they're also linked to his EBITDA. So his actual bonus structure is linked to EBIT targets and average debt sort of performance of where the debt is over a period of time. So all very, you could say it's not that long term. So you could be a bit skeptical about, is he really incentivized for the long term? And that's where the problem is, because I think a business like Currys probably needs a bit of a go down a bit before it goes up. So it needs a bit of it might need, like we talked about, investments and things which might produce a negative EBIT and maybe not pay a dividend and use that cash for something a bit more interesting to survive over the long term.
That's going to be a hard sell to existing shareholders who like that dividend income. I think GlaxoSmithKline recently had a major backlash for that. The new CEO was trying to reinvest more into drug development. So instead of offering a 4% dividend yield, she'd return like 10% annual growth. And people did not like the sound of that at all. they like their dividend. But sometimes you have to be able to make the hard choices. And by the sounds of it, Alex, the CEO of Currys, seems to be doing something right in terms of the e-commerce strategy. He's obviously had experience in the past, and we saw earlier that e-commerce sales in the UK at least are like inching closer towards physical retail as well. We'll see how it goes in the future, I suppose. In terms of advantages, we touched on it a little bit already, in fact, in terms of Currys offering necessary services to find sort of expert advice on technology. But what are the leading advantages for Currys that helps it stand out from its competitors?
So I think to point out, we like to look at, when we look at competitive advantages, we look at three aspects in the Money Cog. We look at pricing power, we look at network effects, and then we look at cost and capital efficiencies. So we see advantages, competitive advantages in those different areas. And for those who want a bit more detail of what those are, they can go and look at the note on the moneycog.com website, or sign up for free if you haven't already to access that note. So for Currys, when we look at pricing power, it has great market share still. It's got about 24% in the UK of the retail market. And if you remember Dixon's and Carphone Warehouse, they were all part of the Currys group. It got rebranded, I think, a year or two back to just be Currys, which makes sense. On top of that, a strong brand franchise in the UK, that if you want to buy a technology product, you will go to Currys. First of all, it's price competitive. And secondly, you feel confident about return policy or buying, and even financing options with Currys are pretty good. The thing with Amazon is that you don't get financing options. So if you want to buy a £1,000 laptop or £1,000 TV, Currys has great credit options. So I think that encourages a lot of retailers as well. Not retailers, sorry, a lot of people to buy that. So that there's that, and then quality in terms of service. So they do have people there that can help you make those decisions. I'm sort of skeptical on that because, when I've been in the store, they don't tend to know a lot. But it seems to be that people do go in there and buy from an older generation. Yet to see the younger generation doing that. Maybe that's one of their biggest issues. When we look at sort of network effects, there isn't any network effects here because it's not a network play. But we mentioned already, it's got sort of cost efficiencies in terms of it's a local market leader, so it can manage its costs from a supply perspective because it has market power, and that can control pricing negotiations with potentially suppliers that they use. And on the back of that, it's got a fairly good Trustpilot score, which is always good for a business which relies on services. 3.7 out of 5.
I think seeing, especially sort of Trustpilot, for those who don't know, is a online review platform for customers to judge or praise the companies they've interacted with. So when we see high scores coming from customers, it can be an encouraging sign that the business is doing something right. So,
what's the Trustpilot for the Money Cog?
I think it's around 4.7. We nudge.
For those who want they can join for free the premium service.
You can also check our Trustpilot score, so we're not making that up. Okay, getting back on topic. In any case, we've been a bit critical so far, but I think it's important, especially from an investor's perspective, to know the threats that a company is facing. So, what are the biggest hurdles that Currys needs to overcome?
As you said, we've been sort of quite critical already of the company, and it's hard to. The thing is, it's one of those things that's very hard. I mean, look, it does make revenue, and it does clearly have, it's clearly got margins, decent margins, making cash flow to pay everything, right, dividends, etc. But again, not being overly critical, but the key threats, which we've already mentioned, just in talking, is the biggest one being Gen Z, millennials buying offline versus online. That's quite an obvious trend that's going on. E-commerce continues to grow. I tend to, I don't know about you, but when you go to Currys store, you might look at something, but you might just buy it online. You might not make the acquisition or purchase there. And then again, it's supply chain, given where we are in terms of, the not just the post-pandemic, but even now we're having massive issues with supply chain issues. And can Currys maintain those relationships and have supply? Because I remember in the pandemic looking for a TV, and Currys, not TV, but a computer screen for work, monitor, and they didn't have one. And just managing those sorts of relationships, and at scale, do they have power? Which I think they do, but it's something to watch. And then again, obviously, as we mentioned, there are a lot of alternatives. Even if the omnichannel strategy is successful online, there's a lot of competitors out there that people go to, like Amazon, for example, is one where people can just buy anything on Amazon. But I think from a technology products perspective, they still have specific competitors like eBuyer, and there's a few others out there, Aeon, and there's many others. And I think even there's another one called OnBuy, again, another platform which is buying technology. So there's so many technology online platforms out there that can compete with Currys. So that's just another worry. And with such thin margins, and we talk about volume, only a small volume change can really impact them, because they don't have huge amounts of margin to play with. So it's something to be worried about.
Just have to keep an eye on how popular these alternative platforms are becoming, and whether or not Currys can demonstrate their superiority. I suppose when it basically comes to e-commerce, a lot of customer retention comes down to user experience. So we'll see if they can maintain that going forward. So with all that said, we've covered management, covered the business model, the risks. Something that a lot of people these days tend to forget about is valuation, which is, a critical final step before committing to any form of investment, is to know what sort of roughly the company should be worth. So in your report, you did a discounted cash flow model to try and derive this. What did your assumptions lead to? Is the company over or undervalued?
I think it's interesting because we've been fairly negative on our conversation with Curry. It's a bit unusual because I think we're normally quite balanced, but I think given what the company does and where it operates, it's a very competitive landscape, as we said, and it's difficult to really say. They don't have huge unique qualities in the company, which makes it great from a perspective of talking about from a qualitative perspective. But valuations, again, I've said, taking consensus and looking at it, it's a downward projection. We talked about 5 years revenues about 10 billion. I just think it's going to be a downward trend. EBIT margins, I think it'll be hard to get to the 4% that the company was saying, kept it at 2.5%, and then discount rate of 10, and you get to a stock price of 125p, and the stock price now is actually close to high 70s. Actually, there is an upside, in terms of valuations, but that just might be. But do you really want to be owning a business which you don't think, it's declining revenue and there might be a repricing, and I think how long does that last? And that's something.
Based off that, it sounds like because you've now got the fears of a potential recession and a slowdown in consumer spending, investors are pricing in that risk factor, making the assumption that things are going to go horribly wrong in the next few months, which it might, but it also might not. We'll see. Only time will tell. But if Currys is able to somehow defy those expectations and continue progressing as it has done in the past, then this, based off what is described in notes, could be a buying opportunity. But like you said, this, for someone like Warren Buffett, who likes finding cheap companies, then maybe this works as a good value play in some regard. But at the same time, do you want to own this business?
I think it goes back to what we look at. Is this a 10x or 100x sort of return business? It's not growing at that rate. So this is a business which has a bit of upside, and it's one of those things, like you say, where you put it in the portfolio and you can get that sort of upside from where it is today, 80 to 125, then that's fine. But if you're wanting a business which you want to hold for a long term, 5 to 10 years, and seeing real growth in that business, then yeah, it's a different one. It goes back to the question, which maybe we could do another video on, is value versus growth. And in a market like now, with growth going one way and the re-ratings of all tech stocks and anything growth, should we be looking at growth? If we're going to a recession, how do we position our portfolios? Maybe that's a specific video we can talk about next time.
We can go into a very long conversation about that, actually. Okay, just to wrap things up, obviously at the end of analyzing every company, we assign a COG score. In your case, you did the same thing with Currys as usual, and I can't say I'm too surprised where it landed. For those who haven't come across this before, this is a metric we use to judge the qualitative as well as quantitative aspects of a business. And if you'd like to know what the COG score was for Currys, then you can have a look at the report. There's a link in the description below. You can access it for free and get a bit more insight into this business. Hopefully we haven't been too negative. I think there is definitely some positive aspects of this company, but all things considered, not one I'd personally be interested in. I don't know about you.
No, it's not. But it's an interesting one to review because it gives you a good indication of a business that actually still around. Given all the negativity we've talked about, it still makes 10 billion in revenue. So it's clearly doing something to still get 10 billion in revenue. And I think, like you say, people forget that. So it just needs a lot of work and probably a transformation to realistically think it'll be around for the next 20, 30 years. Which is probably how we want our portfolios to be, which is businesses that really could be around for 20, 30 years. I mean, I'm a big believer that in the long run, all businesses die, but
I think that's inevitable. Even Jeff Bezos has said the same thing about Amazon. One day it will cease to exist. And I think he's absolutely right, because something else will come along. What that will be, I haven't got a clue. We'll see.
Exactly.
But Imran, thank you very much for joining us again this week. Next week, we're going to be crossing the pond back to America. We're going to be looking at a company called PTC, which is a software business. Next week, look forward to that. If you like this video, please give us a thumbs up and leave a comment. And if you're feeling generous, subscribe. It really helps us out. And thank you.
Thank you.